All right, everyone, we can go ahead and start getting started here. This is the Medical Device Family Office panel, so if you're in the wrong room, now is the time to get out. What we have here today is three experienced investors representing family office groups in kind of the medical device and healthcare IT space. We're going to be sharing some advice for entrepreneurs, some of how they see the landscape today, and we will leave a good amount of time for the audience Q&A towards the end. My name is Michael Quigley. I'm the VP of Research, Investor Research over at Life Science Nation. So largely the fruit of my efforts is kind of all the investors you see here today, the data we track on them that's available in the partnering profile, as well as on our investor platform that we provide on a yearly basis to entrepreneurs who are fundraising and are trying to learn about investors interested in their specific space. So with that, I'd like to let these guys kind of introduce themselves, their firms, what they're looking for in the space.
Thank you, Michael, and thank you everyone for your interest in attending. It's Sean Kearney with Three Leaf Ventures. We're the venture platform for a family office out of Denver, Colorado. We focus primarily on digital health, seed, Series A, Series B, but have invested kind of across the life cycle. Most of our investing has been on the West Coast, but we're diversified pretty widespread off to the East Coast as well. We've made about 15 investments in the past 5 years, many of them in telemedicine, consumer medical devices, and then thirdly in the category of genomics and genetic testing. And with that, I'll go ahead and pass it on to John.
Ron.
That's what I thought. But,
The front of it's okay.
Okay. Or Ron.
Contrary to what this says, I'm Ron Palivoda. I'm with the Palivoda Group. We've been around since '95, focusing on life sciences and IT. We have a health tech fund that focuses on ways to reduce healthcare costs, not just at the hospital level, but all the way down to the consumer level. Because we find that reducing it at the hospital level never translates down to the consumer. I'm sorry, you guys are always going to be paying the same or more. So we're focusing it down to the consumer level. We are looking at specifically projects in the digital biomarkers space and projects relating to genotype diagnostics. A lot of big data stuff, AI. The fund is evergreen, so we've been around, like I said, 22 years. And the way that we like to work is when we bring a project on board, we want to be able to not only provide capital, but also expertise. So we're looking for something that can add value to our portfolio, as well as grow. It needs to be kind of a two-way street.
I'm Brian Grolke with Volcano Capital. So we're essentially a family office acting as a VC. The fund started back in 2008 when a big medical device entrepreneur sold his business to GE for $1 billion, and then took a portion of that capital and decided to reinvest it in early stage medical device startups. So we started up Volcano Capital. We've been in the fund since 2010. We've done something like 16, 17 deals so far. Typically do 510K pathway products with established reimbursement codes, going to be a little bit lower on the risk spectrum. Usually put in $2 to $3 million per round and plan to support the company over 2 to 3 subsequent rounds.
Awesome. And just to get a little feel for the audience, how many medical device entrepreneurs are there? And then any in digital health or with the strong software piece? Okay. And any other investors in the space? Awesome. Okay. So one of the big questions that I always get asked, and I think a lot of people are probably wondering, is kind of how they can find family offices and also kind of how you guys find investments. Obviously, the Resi conference is the single greatest venue for life science investments on the planet. But outside of that, what are some of your main channels and sources for deals? And even more specifically than that, what are some of your channels that when this person or this group kind of tells you that they have a deal you should be taking a look at, that you kind of take a little bit more seriously, if there's anyone you kind of lean a little heavier on?
Sure. So I guess the best deal sources for us are naturally either entrepreneurs we've worked with in the past or investors that we've worked with and put a lot of confidence in. And so we found the best quality deal flow to come from those sources. And so any of your investors, if they've treated you well and you've treated them well, hit them up hard for introductions. Next to that, as a firm viewed more as an institutional investor, we get a lot of attention from large strategics or corporate funds that like to participate in a big way, but often need a lead investor to come in and price the round and set the terms. So anyone from Samsung to Omron, Blue Cross Blue Shield, some folks that we've worked with in the past, that we've found a good partnership arrangement for that. I suppose outside of that, with what we might lean a little more on is those relationships that have been fruitful in the past, either as a co-investor or through other business arrangements. We put a lot of our trust in them as having a good relationship with to help ease the diligence and evaluation process. So I think those are the levers we push on after introduction.
For us, the first layer is our teams, our portfolio. They tell us what deficiencies they have and what holes they would like to be filled, and they may know people in that general area that they would recommend, so we would approach. I'm not shy about approaching. Second layer are our network. We have relationships in the Valley and elsewhere that recognize the value that we provide from a technical basis, and they may reach out to me with recommendations to partner with them. And occasionally we actually get cold calls. Some of them are actually pretty interesting, and we take time to establish a relationship before actually moving forward. So those are, I think, the three main approaches that we take.
I think similarly to the other panelists, obviously the best way to get to the deal in front of us is through somebody we know well. So it's definitely going to be our portfolio CEOs, co-investors. We might even add a good startup lawyer who can help provide an intro. Work with a lot of the same guys over and over there. I definitely do read pitches that are emailed to me. So I don't have like a hard rule that's got to come via somebody that I know. So it is possible, but I think it's a higher likelihood. So you're definitely going to get my attention if it's somebody I know, and it's already frankly been pre-screened. They're not going to. Somebody I know knows what I'm interested in, and they're probably not going to send something that's wildly off the mark.
Okay, so it seems like obviously, referral is better, but it's not impossible to get in with the cold email. Okay, so in addition, after kind of the first step of kind of sourcing and the connections made, with regards to kind of initial marketing materials and even like in the initial pitch, is there anything that you're seeing entrepreneurs really kind of proficient in or missing the mark on that you wish they could kind of tighten up or maybe do a little bit better? Anyone can jump in.
Sure. On the last question, real quick, I have invested in a company I've read about in a Wired magazine before, so good press never hurts.
Published in Wired.
Yeah, Wired. Well, they were in the journal too, so they were around. But that sparked my engagement with them. In terms of what I've noticed with investors, I think the block and tackling is important. It's easy to overlook a good market analysis and just put a finger on a high level figure and say I think we'll get 2% of that and call it a day. So we look much deeper than that, and I think it always helps that help give us faith in the rest of the opportunity that the investors put a lot more thought into really building a good bottoms-up analysis and looking at it from a few different angles to triage what they think a real market opportunity is. So I think that's one category.
What we've been seeing over the last 18 months or so is that the term machine learning has become a buzzword, and everybody attaches that buzzword to any device. We do machine learning this, machine learning that, AI this, AI that. We've been doing analytics for a long time, so we have established internally protocols for really hardcore analytics with respect to analyzing genomes, analyzing from robotics to genomes to signal processing from devices. So my advice is, if you're going to use the word machine learning, please recognize that we're going to come in with our big guns, and if we see that you don't know what the hell you're talking about, that's going to be a problem. So having said that, we do offer, part of our offering includes capital and also technical expertise. So we've created several platforms, AI platforms, we call them AI engines, to provide support for startups that don't necessarily analyze appropriately in our view. So they're able to kind of plug and play into our AI engines. They're sector specific for digital biomarkers to genomics, et cetera, in other sectors. So we're able to provide that solution to selected projects. But for just, if you're going to use the word machine learning, please recognize that somebody is going to look at your claim very carefully. Bottom line is, if I say the word Python and the first thing that pops to your mind is a big old snake, you're not a data scientist. Okay? So that's kind of a test for you guys.
See, so on my side, let's take a step back and say what's the goal of a cold outreach, right? And the goal is not to get an investment from me on that first meeting. The goal is to sell me that it's worth me investing my time to learn more about your business. And so what I'm looking for is anything that would obviously mean the story isn't hanging together, or that somehow you're not credible, there's no chance of you executing on it. So things like wildly wrong on capital needs, obviously not having thought through the market sizing, as Sean said, or unrealistic pre-money valuations, or because the worst thing I can do as a VC is spend 3 months diligencing a company and then have it not go through for something that I could have known up front. So I'm honestly trying to kill it as quickly as I can, and the easiest way to do that is look for things that would connote that obviously you don't know what you're doing. So don't do that.
Yeah, one of the things we kind of talked about on the call a little bit was, particularly for kind of Sean and Ron, the difference when you're looking at a kind of healthcare company as opposed to a health tech, with regards to the target market being either the consumer or more the payers and providers that are going to be footing the bill. Can you talk a little bit about how you kind of evaluate those two spaces differently, and kind of your risk tolerance there?
Yeah, so I'd say there isn't a formula or a model that we adhere to pretty strictly, but traditionally the investors we've worked with that either focus on healthcare or life sciences, they're always looking for efficacy. They want to see the literature, and so the data is the first thing at the front of their mind. Whereas if you go over to the average Sand Hill Road firm or Silicon Valley investor, they want to see the market data, and perhaps crowdfunding used to be one of the first things to look at as an indicator. But those are kind of the two big differences I've seen with how people are looking at consumer and versus traditional life science and medicine that began in the clinic. I think we're pretty agnostic and neutral in that category, so we look at every opportunity for what it's worth and try to dig as deep as we can to make sure that there's some credit to what they're doing. Yeah, I'll leave it at that.
The way I look at it is there's old school healthcare investors that look at the whole business side, regulatory side, go-to-market side. And then you have the new up and comers from the health tech investors. And what they're really looking at is an opportunity to exercise their algorithms in a big data setting. And healthcare just happens to be one potentially lucrative opportunity. So the tech folks would tend to look at devices more in a consumer internet perspective. Okay, so the valuations might be higher on the health tech side. And the way that it's really justified is that at the end of the day, if things don't work out, at least I was able to train algorithms, to train talent internally that then can be recycled into new projects. So that's kind of the risk tolerance, I think, is a little, it's different. So as a startup, you might be able to garner the interest of the health tech guy easier than perhaps the traditional old school folks. But also recognize that the old school folks were looking for clinical data and so forth. There's some validity there as well. And I just point out to companies like Theranos, who did not, classical examples of people doing things wrong. So look at both those perspectives. Ideally what you want is two investors, one on each side, to get the money and get the expertise. If you can do that, I think you'll be well seen.
It's not a question that particularly well suited to answer because we've only done one healthcare IT deal. I will say just from that limited experience, it is a very different game. Much less capital required to get to the minimum viable product. Able to iterate much faster. Scale costs a lot of money, obviously. A lot more money on the competition side. So it's like a lot harder to differentiate between startups. They all say they're doing the same thing, but how many population health startups are there? Not to say there's a big need for it. It's just very hard to differentiate between two startups claiming to do population health. And obviously different investor base. I think one of the interesting things is just having more tech investors coming over with no healthcare experience, as well as just healthcare IT guys. So I definitely think it's different games, different risk tolerances, and different expertise.
If I could add one more thing, Michael, I guess thinking a bit more about it, there is sort of, as it relates to Three Leaf Ventures at least, we do have a different risk tolerance for those technologies that need a bit more work on gathering the clinical data or pulling together the numbers. And I think we're a bit more apt to take on more market risk if we feel that we can visualize that component a little better. And that's probably due to the nature of our our background. Our competencies are much closer to the latter than the former, being a railroad, real estate, and oil and gas investor. So.
Yeah, I think one piece that wasn't quite addressed yet, but we can dive in a little bit deeper is, a lot of these consumer-facing companies, particularly in healthcare IT, they don't have regulatory risk, but they're not facing. They don't have a lot of FDA hurdles that they have to try to get through. So their capital requirements can be a lot less to start really marketing their products. And with that, I know we talked a little bit about it on the call again, but just with the regulatory kind of framework the way it is today, the FDA establishing some new protocols in digital health, how I guess would you prepare, or would you recommend an entrepreneur kind of prepare for the framework today and then have a plan for the potential changes that might be coming?
Brian, do you want to take a first shot since I'm kind of stealing the thunder?
Sure. So we focus more on the device side. So I know there's a lot of regulatory uncertainty around Obamacare repeal, or we know what the healthcare system might look like broadly. The way we hedge against that is you either need to cure an incurable disease, or we need to lower the cost of care and improve the quality of care, or anything else. And so we figure that's a pretty good hedge if you're lowering the cost of care, improving the quality of care, kind of whatever shakes out at the end of the day, you'll probably be well positioned to succeed. But we're definitely not going to invest in anything that raises the cost of care. So, you know, when it comes to things like healthcare IT, you know, there's a lot more uncertainty around the move to value-based healthcare and what the timing is, you know, associated with that. So depending on, I think it's more of a proper healthcare IT than traditional devices. It's something to certainly be aware of. But I know people are trying to look at different customer bases and say, you know, these different segments of the population have value-based incentives, and so we target them first, and as more and more of the market converts to value-based payment systems, we can expand our potential customer base. That's more from the device side, but maybe you guys have something different.
I just want to, you know, this is one of those cases where more regulation is actually good for us. Yeah, mark that. The reason is that it used to be the wild, wild west, okay? That, you know, with the digital biomarker devices, for example, patient privacy, data security, and so forth. You can do anything you wanted back, you know, think of Silicon Valley. Basically, there are no rules. You can do whatever the hell you want, and we'll fix it later. Now that we have some regulation around it, we see mega caps more comfortable moving into this space, now that they know kind of what the expectations are. So I think that it now introduces new partnership opportunities in this space. And there's less of a risk moving forward. Hopefully there'll be less of a risk moving forward from a regulatory perspective, now that we know what the rules are. If the rules are, who knows if they're going to change, but at least we can start moving forward with some semi-tangible items on our risk profile. The mega caps, if I can just expand on
Yeah.
that. It's really interesting. I just kind of flew back from the valley. Boy, my arms tired. Just kidding. But it's really interesting in terms of the challenge that the mega caps are introducing into the health IT. Healthcare is a greenfield opportunity. Everybody is going in that direction, and what we're seeing is that early stage companies that are not able to protect themselves, they're going to get crushed. Okay, you can't fight Google, you can't fight Amazon, you cannot fight you know, Microsoft and so forth. They got capital. They can crush you easily. So now what we see is an opportunity for us to re-examine projects and see, given the nature of the changing competitive landscape, what is the next step. So instead of just continuing to burn cash, it's time to move on. Okay, so some founders tend to be too hopeful, but I think now that they see there are certain big elephants in the room, you can get moving on that. As an investor also, I like to see that there are competitors out there, because they are looking to not only grow organically, but they're acquiring talent at this particular point. So in terms of my risk profile, I'm comfortable in investing in something that is a little bit more extreme, because I know that at the end of the day, if this doesn't fly, I know that the talent pool can be acqui-hired by one of the big mega caps. So it's important to kind of activate that talent pool as part of your assets.
And are you seeing a lot of these mega caps, like you say, coming and also funding early stage companies externally?
Absolutely. There is, yes. Yes. There are certain announcements that have probably, you know,
Yeah.
they do prefer to acqui-hire at this particular point for their own reasons. We do things in genomics that people are really excited about. So we are aware of I know what my competition is doing, and yes, that's why.
Closing on the final, on Ron's last point there, yeah, I agree. We've definitely seen large corporates come in and buy rather than build innovation more increasingly, and from new locations geographically and sector-wise. Back to the regulatory question, I think the way that we've seen our portfolio companies go through those pathways, I would advise you be very specific and when you work to pull together your advisors or consultants to help determine your pathway and your strategy, to be very specific about who you're pulling from. Just because they're a retired director from one division doesn't mean that translates perhaps even in that division, depending on what it is. But each channel of the FDA can be very different and respond very differently. So make sure that you get as close as possible as you can to that particular division and as recent as possible to dealing with that area because it's a volatile subject matter. The other, I think, thing I would say on that point is that despite some of the rhetoric coming from leadership and above, that doesn't always translate, 1, 2, 3 levels below. And so, your actual feedback and your interactions through the regulatory process might seem completely inconsistent with what you might read on Rock Health or yesterday's news release. And then lastly, give consideration to other regulatory environments prior to FDA and make sure that it doesn't make sense to go for a CE first or some other market where it might be easier to get traction.
And back, I guess, specific with the kind of the family office theme, a lot of the entrepreneurs we work with come to us kind of specifically stating that they're, searching for a family office investor as opposed to a traditional venture capitalist or corporate strategic. Can you elaborate a little bit on kind of how you see the similarities within your own group between a traditional investor and a family office like yourselves, and how that might be in line or out of line with kind of what you think entrepreneurs perceive you as?
Historically, I guess family offices were the longer term investor. I think that the differerences have narrowed between VCs and family offices. I see VCs that are now much more realistic in terms of their outlook, time horizon. Maybe back in 2008, 2007, when the whole mobile boom took place, there was much more churn in a shorter time frame. So I think people have finally, at least in the health sector, finally recognized that health is hard to fix. Okay, and it's not like the consumer internet. You gotta have it. You gotta be dedicated for a longer period of time. The sales cycles into hospitals are much longer than you'd expect. The burden of proof is much higher than you would expect, and therefore your time horizon should be extended. So they're much more strategic about VCs, and now much more strategic about the deals that they're looking at. They're looking to. We've been working with certain portfolios to help them through our AI engines to help them look at their data and see in assets that are underperforming where there might be value that they haven't recognized before. So they're not abandoning; they're reconsidering and adding more money in a different direction.
I'd say, I guess traditionally, why are people excited about family offices? I'd say probably twofold. I think first off, most VCs have minimum investment requirements that are more like probably Series A or later. So if you're looking for something sub $5 million in the raise, you're probably going to be the family office. So it might mean that you're just talking to earlier stage companies that need less capital. that wouldn't be appropriate for a real bigger VC. I think there might be a perception at some level that family offices are less valuation sensitive. I think that depends on the family office itself. Some of them have more philanthropic missions that might make them less valuation sensitive, but I would say that's not the case generally. For us, our only goal is financial return, so I would put us in the same category as VC.
I guess similar to what Ron and Brian had touched on, the stereotypes are that it's typically friendlier capital, maybe less stringent on certain conditions. I think in our case as Three Leaf Ventures, we might not have a multiple or a cash on cash that we have to go and fundraise 3 years later on that we'll need to hit and push you towards. But what we still have is we have IRR thresholds that we forecast when we make each deal, each investment. In our company, over the history since the 70s, has an audited, I think, 44% IRR. So the bar's not low, but I think the difference is our life for bringing new capital in the door to invest in your company is not dependent on the traditional fund cycle of a structured partnership. And so for that, we're a little more flexible, but recognize that still the economics are pretty similar in terms of how we look for our investment and then subsequent return.
And what about, go ahead.
So that's a good point. I think on the holding periods, I think it goes both directions actually. So we can consider deals that would exit sooner than traditional VC or longer. I think if you look at a traditional VC, if they flipped it in 2 or 3 years, they have to return the capital to their LPs, and if they want to go do further investments, they have to raise new funds to go invest out of. So it's like they'd rather get a lower IRR but a higher multiple in year 7 than really high IRR in 2 years, but then have to go raise the capital again. So I think there's flexibility there. I think there's flexibility on sector concentration, portfolio concentration. We don't really have the same rules as much on our side. That's a good point.
And what about in terms of kind of your diligence process and the level of dive that you take into a company when you're reviewing? Do you think that's in line with what most of the VCs out there are doing?
On my side, yes. I think we've got similar time frames.
And also, if you could just elaborate a little bit on what your typical diligence process might look like.
Sure. Probably about 6 months. Depends on the deal, where we think the biggest areas of risk are, and we'll double down and validate each one of those. So if it's on the clinical need, we're going to talk to a bunch of different clinicians and just make sure that's the case, that it does add value that we think it would. If it's regulatory, we'll talk to our regulatory consultants. If it's reimbursement, we'll talk to reimbursement consultants. And to check through to make sure we get comfortable with everything. And it usually takes about 6 months. It can be a little bit faster if it's a space that we're particularly familiar with, in which case we already know the clinical need maybe much better already, already have KOLs that we trust that we reach out to on a much faster basis. We can kind of accelerate things a little bit. But I'd say reasonable target would be about 6 months.
We prefer to look at projects that add value to our portfolio. My rule of thumb is I'll look for 2 things. How can I help, and what do I get for it? So if you're telling me that one of the benefits of having this new project in our portfolio is that we're getting big data availability to train our AI engines, that's great. Okay. There needs to be something more than just a transactional component to this. Longer term relationship is important for us, so we might become a client first, and then over time, if we feel comfortable using a service or a product, we would then invest. There is no really specific time frame associated with any of those issues. It's a building relationship that you can't define that on a calendar. It just takes time. And I also want the project team to be comfortable with us. So it just takes time.
I think our diligence process probably pretty comparable to the traditional VC, though there's probably more of a range in outcomes. So we've pulled the trigger on investments as soon as 6 to 8 weeks from introduction. That's only happened once, maybe twice. And then on the latter end, have been involved in conversations for up to 6 months before we, or a bit longer, before we get involved in a meaningful way. But I think what we shoot for is 2 to 3 months to get things wrapped up. But depending on the deal, it might take us a bit longer to get to the table with understanding everything. And really, I don't draw much of a line between diligence period and introduction, because to me it's kind of from day one. We try to get in the data room as soon as possible, so we can have the team attack that category, and otherwise spend most of our time engaging with the people, as it's a big part to our investing.
Awesome. All right, so we've got about a little more than 10 minutes. I want to open it up for any audience questions.
It sounds like from what I've heard, that what you're saying is that from a you're raising funds, it's a totally different model than VC, but in terms of just providing funds, it's very similar, extremely similar. And I'm wondering, and I'm not hearing the factors of providing value or value to the community as part of the family mandate. Is that a romantic vision, or is it real and you guys are the ones who do that, or where does that idea fit into family office?
You're talking about impact investing?
Yeah.
I think we make an impact. I mean, I don't think we're greedy. I think we're realistic. I think there are certain family, we're not one of them, but there are certain family offices who would issue grants. Okay, this is not us. We don't do grants. We do equity. I think it's much more efficient, cash-wise, to hold people accountable. Because if a grant, they can do whatever the hell they want. But if you have equity, you can more appropriately enforce certain technical adjustments and focus on the overall mission.
We don't put a big emphasis on impact investing, or I think we do as part of the benefit that Three Leaf Ventures provides to the capital provider, the Bro Group, is helping to add and contribute positively to the brand. So when it comes to investing locally, I think that does have an impact. But at the end of the day, we want to make a difference either in cost or outcomes in healthcare. And so that's the impact that we see. And I think if we're driving towards an economic outcome, then it will be fulfilled.
We're similar. The family has a lot more capital than what they've allocated to Volcano Capital that we directly manage, and we are measured against all the other outside managers that they can hire. Right? They can put money to Volcano, or they can put money into OrbiMed or any other outside manager. They do have a charity set up that they do grants and things out of, and other philanthropic ventures out of. That's entirely separate, and our entire mandate at Volcano is a financial return.
Yep.
Do you mind to talk a little bit about your decision-making process, and how do you get to that yes on an investment?
That's a hard question. To us, is about two things. One is the science there? After our analysis, do we feel that the science is there? The second thing is the human relationships. Are we aligned in terms of our goals with the founders? there could be a lot of drama involved sometimes. So we don't want to be in a situation where we're looking at things too different. So, and that takes time. At some point, if you can come to a deal that says, look, this is what we can provide, this is what you provide, and if the numbers line up, pull the plug.
I think the first, I'd say the first 10% of the time you'll spend either through introductions is getting past the first call to the second call, or a more involved conversation. And then up until I'd say 50% of the time spent will be getting myself and Three Leaf Ventures on board. And then from there on out, it's completing diligence, and the last, I'd say 25% will be spending the time getting through the investment committee. And so the difference, I think, for our group versus venture funds is that I see I'd say at least 90% of deals that come across our desk. So I'm involved from the very beginning.
So I'm not part of the family, and so, but they are luckily involved on a day-to-day basis with the fund, and so that simplifies things a lot. And so it's basically they're, involved from the beginning. We all agree on what the key issues are to diligence. General process would be, hear the pitch, get a sense for whether we think everything kind of makes sense, the story makes sense or not. If we like it, we tend to do an LOI or term sheet much earlier in the process, maybe than other VCs, just because we want to have some rough idea that we're in the same ballpark. I don't want to do 3 months of work and then find out you want a $100 million pre-money valuation. And then so if we're all kind of aligned conceptually on what the business is and it makes sense, and we're all aligned on what the deal economics might look like, then we go ahead and invest the time to do all the due diligence. And again, the family's involved, actively in helping to address whatever issues we think exist in the business. And we get comfortable, we do the deal.
Jason?
Yeah, from a standpoint of the family office and working with syndicate or other investors, do you ever do anything just solo, completely the family, and not work with, come in with VCs or other funds to start those? And then the second thing is there that magic percentage where you have to, in your business model, you have to have, like a lot of VCs, 20% or better, and so usually the money that you ask for is a reverse piece of math. Doesn't exactly mean it's what you need. So having played that game, is there any difference with the family office?
So on my side, we've invested as part of a syndicate, and we've invested entirely on our own. The big difference that we see is one of the biggest risks, I think, in startups, at least particularly medical device startups, is a follow-on financing risk. And so if we're investing alone, it means that we think we have the capital to take it across the goal line entirely by ourselves. We don't like to invest, $7 million and then find out that they're going to run out of money and we can't raise from another VC. So one way to manage that risk is to get a syndicate in place.
Sure.
And so if they need, more than 10 or 15 million over the life of the investment, then we'd like to try to get a syndicate together that we're part of. And again, it's all the normal issues around making sure that you're all aligned in terms of fund life cycle and vision and strategy and when you exit and all those kind of things. And personality-wise, that we like them. But yeah, we've done both models, and it's all driven by capital needs.
We're discussions of money are at the startup stage are not as important as the discussions of talent on board. Okay, I would rather having the right advisors coming on board from a business development perspective, a product development perspective, are much more important than I want 21% or 22% or 15.5% and so forth. Because 20% of zero is zero. So at the early stage, it's more about getting the right support for the team. We have internally certain levels of expertise that we're very comfortable with, and we can also bring on board other types of support as needed, but every deal is different.
Do you consider yourself a value-added investor?
Absolutely. I think that I add value.
Like, why wouldn't you want at least a significant chunk of the business, right? If you owned 2% of the business,
Right?
and the value you add is captured 98% by somebody
Right.
else, why would you do that?
Excellent point. Number one, I'm not a greedy bastard, and number two, I want, you are, but I want to establish a longer-term relationship because a team that has a good idea are likely going to have an even better idea next time. So if I don't go and screw them right now, I can have a frank discussion later on the next deal. And that's how we grew. That, if I have somebody who can call me right now and say, hey, I need, I don't know, $10 million to do this deal. I'm like, go ahead, because I know, right? So it's about establishing relationships and trusting people's talents, and it just takes time to do that. Now, having said that, I'm not going to be stupid about it, okay? But the discussion shouldn't be initially, I want 2% versus I want 20%. I want to grow a business. And by the way, many times what I do is I don't take any equity. I refer people to people in my network to let them grow the business before I come in. So that's important to me, establishing longer-term relationships.
So for us, it's rather the model.
My name is on the firm.
We've not been the sole capital source for any of our companies. I think that's more of a market. I'd say it's more common to have a syndicate. For us, we view it as a risk mitigator in a couple of ways. Capital, of course, but also we found that the folks that we work with are able to add a lot of value in areas that we don't have a background in. And so I think having a diverse base of experience is always helpful.
Yep, in back.
I just wanted to say I love your comment on it. I thought it was very meaningful being a serial entrepreneur. It's true. If you get somebody that was, and I had in my last company, put all the money in, I would never go back to it.
Well, I appreciate that. One of the biggest mistakes and greatest values I have in the firm. When I started the firm, I'm a scientist. I'm not a creative kind of guy. So they said you need to call the firm something. I'm like, well, I don't know. So my last name is Palavoda. It's okay, I'll call it the Palavoda Group. So that was kind of an accident, which turns out to be the biggest asset because moving forward, everything that we do my name is on the firm. Right? So we do things ethically, we don't screw people over, and chances are that if somebody had good experience with us, I want to continue that dialogue. There's always, and that's how we get referrals from people we trust. Like I said, we've been around for a while, and we expect to be around for a longer while. And we've been growing not because of anything that I did, it's because of the people that we surrounded our team with. So that's kind of the way that we do things. Not everybody does it this way.
I feel I'm being unfairly maligned. I mean, I think, we don't have
Brian has been maligned, everybody.
We don't have any
Give
firm
some Brian
targets.
some love.
Just to be clear, we don't have firm targets, but particularly if we're going in early stage and putting in multiple millions of dollars, we want a reasonable percentage of the business, and it's market. I don't think we're asking for a $1 million pre and taking 75% of it. But if you consider yourself a value-added investor, I think you need a reasonable percentage to make it worthwhile.
First of all, the only place I ever look for pythons is in the jungle, so I hate to ask Ron a question, but
What's Python? That's a question?
No,
That's a programming
that's-
language.
No, that's not a question. I'm just curious, you see, so we've got this subject family offices,
Yeah.
and how they might be different from strategics, from VCs, et cetera, and you see yourself as a real center of excellence in a particular technology area. And-
Funny you asked that
Well,
question.
and And Sean, you said you like to be lead investor often. And I'm wondering, is that typical within family offices or not, or kind of how you're changing my view about how I would have thought about family offices.
I think.
Brian, I'm not sure how you would fit into that also, but
I think that the investment landscape in terms of investors has shifted. No longer is it sufficient to provide capital. You need to provide some excellence, some technical excellence moving forward. What we do is we use our what you call innovation office. It's actually something we haven't announced yet. It's known, but we have a data lab, part of our Palo Alto lab, so we have a lab section. So it's essentially what you would call a center. It's an innovation center. But what we do is, for the purposes of our due diligence, we rely upon that technical expertise as part of our due diligence. Okay? And part of the offering that we have for startups is not only capital, but that technical expertise, which I think differentiates us and maybe allows us to ask for the 20%. We want to make a justification to that. And I think you see other VC firms aligning or enhancing what they bring to the table, not only just capital.
And yeah, to jump in there too, so these guys are all speaking based on their experience from their own family office. And I think this is true across, we've done a lot of talking about, VCs, family offices, these kind of broad categories. But with really all investors from my experience, and even more so in the family office space, trying to categorize them as a type of investor isn't a good service to yourself, and that you really need to research the individual group. Because levels of experience, I mean, these guys have been professionally investing in venture for some time now. A lot of family offices are kind of just getting into it. And in cases like that, they might not have the diligence expertise, more comfortable just co-investing. So it really is a case-by-case kind of thing. Yep, sure.
So you were talking from 6 months all the way to 6 weeks, and so is a family office, do they move slower than some of the other traditional VCs and such? For example, yesterday we finished beta at UCSD, so I bought this ticket last night. Nice. And on the red eye, so now we know we go build it, got a PO and ready to go. But 6 months is way outside the range of where we want to go. And again, is that a family office thing versus some of the smaller VC types? Kind of out of my league, never raised this little of money before, so curious on that speed of
yeah, so I think oftentimes our first introduction to entrepreneurs is prior to fundraising, and so that probably is what's stretching out the longer end for us. But 6 months isn't that long for a fundraising process. I hate to say, a lot of everyone's setting a goal for 3-4 months, but when you look back and you determine when you actually went on the road to when you wrap up the financing, it's a bit longer than you think, unfortunately. So,
fair enough.
Yeah.
Thank you,
Only
guys.
6 days.
So you cash out as next week?
Thank you guys, appreciate it.